Hello, I'm Lizzie Joe. This video covers all the little topics that weren't covered elsewhere. There is a reason we didn't cover them before. It's because they are so boring. You might just want to print out the notes and look them up in your book. But if you need some explanation, everything's here. Good luck, and good luck on your first exam.
There's a few little topics that we've skipped in chapters 1 through 4. So this is just odds and ends, things that aren't really critical to the chapters, but things you should know. We didn't talk about ways to organize a business. We just kind of assumed you were a corporation in everything we've done so far and will do throughout this course. But we do have some terms you should know. A proprietorship is if you have one owner. A lot of times companies will start out as a proprietorship where you might decide to do your own lawn business, and so you start mowing people's lawn. You're a proprietorship. Sometimes it's called a sole proprietorship. The next one is a partnership, which is similar, but your company gets big enough that you think you'll bring in a friend to help you mow some of the lawns, and you decide to split the profits. And so there you have more than one owner. The biggest difference between those is the number of people and kind of how formal you have to be. With both of these, earnings goes on your personal tax return. So a lot of the organization deals with what you're going to do with taxes. Another difference or another common theme between those is if you get sued, you are personally responsible. So let's say that you're mowing somebody's lawn and you run over this lovely plant that they have nurtured for years and years, and say you destroy a tree. They can sue you, and if they claim that tree's worth $1 million, they can make you sell your house in order to pay that $1 million. So that's one difference. This, you really do need to have a formal arrangement if you are going to have a partnership where you spell out, I get 50%, you get 50%, I get 60-40. Are you talking percent of the earnings, percent of the revenue? Instead, exactly how you're going to divide it up needs to be formally documented. That takes us to a corporation. A corporation, what makes that different is it is a legal entity, which means people can only sue the corporation, which is, there's other reasons too, but that's the big one people care about. So now if you would destroy that beautiful tree, the people suing can only take what you've got in the corporation. So they could take your lawnmower, but they probably can't take your house. You have shares of stock, and that's how you're going to divide profits. So every share of stock, in essence, has the same value. So if one person owns 10 shares of stock and the only other person owns one, then 10/11ths go to one person and the 1/11th goes to the other person. It will still be something you have to file, but it shows you how you do that. And the other thing about taxes is only the dividends are taxed to the individual, but then the corporation pays its own taxes. So again, in the next year, you're going to hear a lot about corporate tax rates. Are they too high? Are they too low? That's where the corporation pays those taxes. We only pay as individuals on the dividends we receive. So the structure is very different. A corporation's kind of expensive to set up. When I talk about these shares of stock, they do not have to be traded on the New York Stock Exchange or if you've got a lawnmowing business and it gets big enough, you can sell 5 shares to your mom and dad and 10 shares to your uncle and another 20 shares to your siblings, and you can still be a corporation and just have, it's called privately held stock. And lots of big companies are privately held. Enterprise is privately held, and so lots of big companies are still privately held. Just means they don't sell their shares, but they're still corporations and they have shares. It's just not you and I can buy them. A problem with an individual is this: getting sued. You don't really want to have a business and lose your house because something happens. And so the government came up with some kind of intermediary things called a limited liability partnership and a limited liability corporation. And the key things there are limited liabilities. These don't take the same amount of paperwork as setting up a corporation, but they take more than setting up a partnership or a proprietorship. What you do here is you're still a partnership or a corporation. You can only be sued for kind of the assets of the LLC or LLP, and that's what people will call them: limited liability corporations or limited liability partnerships. To decide if you're a partnership or a corporation, this depends on the kind of business you are. LLPs are things that have always been partnerships. So law firms are always partnerships, so they'll be an LLP. So Brown and Crouppen is a LLP, Brian K. For you going into accountants, all the CPA firms, those are all LLPs. They're partnerships. So if you go to Price Waterhouse or Ernst or Deloitte or Sheffel, all of those are limited liability partnerships. Doctors' offices a lot of times are LLPs, things that normally were partnerships. And then LLCs are more, usually those are kind of more what we call businesses as opposed to services. Rottler Pest Control and those types of companies are all LLCs. The important thing is, no matter if you're a partnership, a proprietorship, or a corporation, in accounting, we do accounting for the economic business entity. And so what that assumption means is we keep our accounting for the company separate from the individual. So even though if you're a proprietorship, you're going to pay taxes on your personal income tax, for accounting, we're going to keep the company separate. We care only about the expenses for the company. So again, you have to be real careful if you're a sole proprietorship. If you buy gas for your lawnmower, you will need to keep that separate from the gas you put in your car or your own lawnmower. We always are just looking at, that's why it's the economic entity, we look at the business as a separate entity from the individual. Accounting is just that. We're taking an accounting of what happens. We do not create any transactions. And if you do, you can go to prison. So no creating of transactions. All we're doing are recording what's happened. So we need a way to find out what happened, and we just don't want to call around and say, hey, did you make any sales today? So we have source documents is what we call those. And so those are the documents that kind of verify that a transaction. So those are all those, we need a paper trail. And we don't want to do anything as somebody verbally said, oh yeah, I got a refund, or oh, of course I paid some cash. We need something in paper. So even with the computer, we need some kind of receipts. We might have some bills that we see. We'll have checks, all that documentation that you have. And again, in the olden days, we always called it a paper trail, and we really wanted to see it on paper. You can use the computer, but you need extra controls to make sure that people, in fact, are doing what they say they're doing. So The key to this, again, never verbal. If you ever watch the judge shows, they'll always, somebody will say, well, there was a verbal agreement, and the judge says, well, that's the other side. No, we never. Always get something in writing. This is just called the fraud triangle. People do illegal things if there's pressure, motive, opportunity. And the one that's different here than what you see in Law and Order and all those sorts of things is there's almost always rationalization. In frauds, people always say, oh, well, I know, but I pay it back. So I took that $200. I went to the boat and I knew I would double it and be able to pay it back, but I couldn't. Or, well, I'm just stealing. Somebody at a bank in Highland stole a whole lot of money and said, yeah, but I was stealing from the bank. I never stole from the individual depositors because they're my neighbors. So there's often a rationalization on why it was a bad thing to do, or they were just in a bind and it was going to take care of itself. And it just, rulemaking bodies, we've never mentioned it, but the key thing is these are two different groups and they have very different incentives. For the taxes, the rules are set by the IRS. And again, if you think of that middle word, that's revenue. The point of the IRS is their goal is to collect the appropriate amount of, I'm going to put taxes, is revenues for the, so they're trying to collect stuff. And as taxpayers, we're trying not to pay them. So the incentives here are very different. Financial Accounting Standards Board, which we call FASB, if you want to know it. So it's F-A, when you pronounce it, it's usually more like F-A-Z-B-Y. I actually had a dog I named FASB. It's kind of cute. It's one of those subtle accounting jokes that not many people understood. So the Financial Accounting Standards Board, they write the rules. And so their goal is to make sure financial statements performance of the company. And the reason these rules are so different, if you think about on the tax side, we're trying to say, oh, I got no revenue and tons of expenses so that I don't have to pay as much tax. For financial statements, I usually want to look like I've done really, really well. So here I'm trying to increase revenues and decrease expenses. So the rules are very different because the incentives for people are very different. So these people are saying, you know, they've got a lot of emphasis on making sure you get all your expenses. And this one is got lots of rules saying don't overstate your revenues. So the rules are very different. And then the last thing, the FASB makes the rules for accounting. They're called Generally Accepted Accounting Principles, which we pronounce as GAAP. The next thing we want to talk about are the ratios. The first one is return on assets, and that's just looking at the overall performance of the company. Given the assets that you got, how much money did you make? Seems like if you have $1 billion in assets, you should make a little bit more than if you have 100,000 in assets. So this is just a way to standardize it. Notice it's net income over average total assets. Remember, this is on the income statement and this is on the balance sheet. And the income statement is for the whole year and the balance sheet is just at the end of the year. So generally when you see a ratio that has one side's income and one side's balance sheet, you average the balance sheet because this happened throughout a whole year. So you want to kind of know what the average was throughout the year for your balance sheet side. So that's what we're going to do here. The average is just the same way you learned it in whatever, 5th grade, where you just add up all the numbers and divide by the number of numbers you have. Does that make any sense? In this case, we always just have 2 numbers. So we're going to have the beginning, in this case, total assets. The second observation we have is the ending total assets. Since we have 2 things there, we divide by 2. So it's just like if I have somebody who's 6 foot tall and somebody who's 5 foot tall, I add the 2 together and divide by 2. And that's how I figure out the average of the height. So if I look at Louie's lawnmower up here, I didn't give you last year's total assets, so we'll assume that's 40,000. Looking here, total assets for this year is 52,000. And you can get it here or here, obviously the same number. And then our net income is 36,450. So I need to take my average. So 40,000 plus 52,000. Kind of add that over here is 92. Divide that by 2 and 46. Be really careful on your calculators, because if I do 40 plus 52 divided by 2, it's going to take the 52 divided by 2 and then add the 40, and you're going to come up with the wrong answer. So again, in your calculator, if you're going to do it all in one step, you got to remember to put that in parentheses. Otherwise, it's going to blow up on you. The other thing, just always double check. If I'm averaging 40 and 52, I better come up with a number between 40 and 52. And here I could even kind of eyeball it. It should be 6,000. There's a $12,000 difference. So 6,000, that should be 6,000 more. So use a little, we call that number sense. Think a little bit about your answer, because this one, your calculator is going to throw you off. Once I got that number, that's my average assets. Then I can take my 36,450, divide it by my 46,000, and that's going to give me just about 79%. And again, kind of eyeball that, looking at that, it's got to be greater than 50%. Can't be more than 100%, given what I've got here. And here, what you're looking for is, in general, bigger is better. The actual numbers are very industry specific. Grocery stores, you probably will have a little percentage. High things where you've got lots of assets, like car manufacturers, probably have littler numbers. And there's actually places where you can look it up and see what the industry average is. The next one is your debt ratio. Notice these are both on the balance sheet, so we don't have to average anything because we're just taking that snapshot of what things are that day. Liabilities would be on this side, so it's the 17,050. My total assets, I already know. I can pull that from here. I can pull that from there. I've seen that one. So that's my 52. I'm going to put 30%. And that's a way to measure risk, because basically what that is telling you is kind of the percent of the company owned by the creditors. That means as an owner, as a shareholder, you own approximately 62%. Did I do my math right? And again, here, smaller is better. The less credit you have, the less loans you have outstanding, generally is a little bit better than the more. So that takes us to liquidity. Liquidity is how quickly can the company expect to have cash. So we have things called current assets and current liabilities. And those are things that we expect to turn to cash pretty quickly. Your current assets are cash is already cash. Accounts receivable, we hope to collect those within the next year. Supplies, we bought in order to use up in the next year. We prepaid our insurance, so we're going to use that up in the next year. So what things will kind of convert to cash in the next year? And so both the assets and the liabilities, something's going to happen within 12 months. And they're liquid because, if I needed to, I could call my accounts receivable and say, pay me up now, or pay up now. On the liability side, it's the same thing. Anything that's converted to cash or will convert to cash or will come due in the next 12 months. So accounts payables, your most common one. And then these other ones are ones we're going to use up in the next year. So those are our current liabilities as well. Another way to look at them, short term, things that will convert over pretty quickly. On this side, it's going to be cash, your accounts receivable. If you have inventory, hopefully you're going to sell that inventory. Those are your current assets. And then your current liabilities will be your accounts payable and any other little things you get. For Louis over here, and I've got it subtotaled where my current assets are 25. My current liabilities is 12,050. So my current assets, 25,000. Current liabilities is 12,050. And so that's 2.07. This is one of the few where there's a number you really want. The general rule of thumb, you want this to be around a 2, meaning we want to have enough cash to like pay off our liabilities, our current liabilities twice. It doesn't have to be straight up cash, but things that in the normal course of business are going to become cash in the next year will cover the liabilities that are going to come due in the next year. You can hedge a little extra on hand. So if worse comes to worse, we have a pandemic and all of a sudden things freeze up a little bit, I still have enough to get by for at least a little while. So that's what the current ratio is all about. The balance sheet will look like what you saw on Louie's lawnmower. We want to kind of keep our current assets and liabilities separate. If the current asset liability is going to come in within a year, or the operating cycle, which is one of those trick questions you'll talk about if you take the intermediate. They're considered current, otherwise they're long-term. We do want to define this operating cycle. It's kind of the time it kind of takes to go from cash to cash. You'll say, what? If you think about what you do in a company, you put in some cash, you go buy some inventory. When you buy the inventory, you might have some accounts payable to help you buy it. And then you sell it and have an account receivable when you sell it. And then hopefully those people pay you back in your cash. And then you take that cash, buy some inventory, go to accounts payable, accounts receivable, and cash. So the amount of time it takes between here and here is what you call your operating cycle. So again, if I'm a grocery store and I'm selling bananas, that better be a week because those bananas are going to get pretty ugly. If on the other hand, I'm a jewelry store, it might be 6 months. It might be 8 months between here and here. And if I'm Boeing and I'm building an airplane, then it might be 4 or 5 years. The standard operating cycle that's longer than a year, if you see that ad where they're doing whiskey, I think, and the gal with the big eyes goes down and she said, I'll come back and get you in 3 years to the barrel there. That's a 3-year operating cycle because it takes that long to do the inventory. So for 90% of us, it's less than a year. There's a couple industries where that operating cycle is longer. Your current assets that you want to always look for, it will always be those 3: cash, accounts receivable, and inventory. But if you have prepaids, most of those you only prepay a year in advance, sometimes like insurance, 6 months. So those prepaid accounts and your supplies account, those are also current assets. So you expect to use them. The prepaids usually pay up for 6 months. Then your long-term assets are the things that just hang around forever, and you buy them because of that. So that's your land, buildings, we'll put equipment, getting even bigger than that, your buildings. automobiles are another one. So any of that kind of thing, that's long-term. So you should be able to kind of see the difference between a long-term and a short-term. It's another little trick question that you'll see in some multiple choice. There's depreciation on all long-term assets except for land. We don't depreciate land because this kind of goes back to the beginning of time where land does not lose value. You can always sell the land for the same amount at least that you paid for it. Maybe not always true, but it's the assumption we make. The equipment, buildings, and the autos you use up, the land is just there. We don't depreciate land. And one last thing to confuse you, and we're not going to talk about this probably throughout the whole semester. We might get to it as the very last chapter. There's one more financial statement called the Statement of Cash Flows. It's made up of 3 parts because investors care about where cash comes from. We divide it into operating activities, and that's really the reason we do this, because we want to know how much cash do you get from your normal line of business. Investing's kind of more, this is how much you get from buying and selling those long-term assets. So if you have a whole bunch of cash, but it's just because you sold off every factory you own, that's not particularly a good sign. And then financing activities is just that, how much you get from loans and selling stock. There's nothing wrong with getting a loan to do something, but we really want to focus on making sure that you can succeed with your regular operating activities. Last but not least, don't let this thing scare you. Read through this, or if you want to go through the book, do it that way. Just a couple things. We already talked about this one. Rules, we already talked about that one. Economic, we already talked about that one. Going concern, we talked about that in the video. Cost principle, we record things at cost. Conservatism. When in doubt, we want to be conservative. Again, in accounting, book losses and be real careful about booking revenues, but that's only when in doubt. If you've got another principle that guides you or a rule, you follow the rule. Accrual accounting, we've already talked about. Revenue recognition, again, we've talked about that one. This one, the matching, we match expenses to the revenues. So you need to start here. You need to know your revenues first, and then you match your expenses. We never go the other way around. We don't start with the expenses. And then the one thing we haven't talked about, though we did, is when we post it to the ledger, we need to have a chart of accounts, which just makes sure that everybody books something to the same account. Every now and then, again, if you're an accountant and you go to some sole proprietorships especially, you'll go in, and some weeks utilities will go to utility expense, some weeks it will go to miscellaneous expense, some weeks it will go to power and light expense. You want to make sure that if it's utilities, everybody puts it under utilities. So a chart of accounts is just a list of accounts you're allowed to use. You should be ready for the exam now. Have fun, and if you have any questions, let me know.